On the 28th, we get back at
Good afternoon, everybody. This is Jeff Finn, CEO at RealNex, and delighted to have you with us today and joining us for the RealNex Webinar Series. Today, we are delighted to have Dr. Glenn Mueller from University of Denver's F.L. Burns School of Real Estate and Construction Management. Glenn is noted for his work with market cycle research for income producing real estate and real estate securities, as well as public and private real estate investment strategies and capital market analysis. Given the activities of the past few weeks, and particularly the past couple of days, also joined today with Dr. Jeffrey Fisher, who is the head of research for RealNex. So Glenn will focus on his market cycle monitor, and Jeff might add some commentary on the coronavirus and some work done recently with some of his colleagues in that regard, and how the impact to global markets might impact our real estate markets. And while many of you are longtime RealNex customers, some are new to RealNex, I'm going to do a quick intro to RealNex for you, then turn the program over to Dr. Miller. 1 second, and we will get started.
Business as usual isn't good enough anymore. The future belongs to the technology-advantaged power broker. Power brokers get more deals done faster with RealNex, the most complete commercial real estate technology solution for fast lead generation, complete financial analysis, beautiful presentations, stimulating marketing, and successful deal management. With RealNex, power brokers quickly profile people and properties to most efficiently prospect for new business, manage deals, and report on activity. No one knows the market better than a RealNex power broker. They have complete data on market inventory, comparable sales and leases, hidden spaces, and the most active buyers, sellers, and tenants. They efficiently collaborate with clients using the RealNex Tourbook leasing app and run accelerated sales processes in private and secure deal rooms. Power brokers eliminate redundancies and save time with automated investment and comparative lease analyses, and they swiftly create an incredible array of professional, elegant, and consistently branded marketing materials. When it's time to go to market, a RealNex power broker can economically run highly targeted e-marketing campaigns to their private prospect lists, or instantly tap into the vast RealNex community to assure no stone is left unturned. Power brokers can even leverage 3D virtual reality to improve deal cycle times for buildings and spaces, and instantly assure clients the space works perfectly for them. Power brokers effortlessly impress their clients to instantly save more time and make more money. The future is now. You too can be a power broker. Boost your results. Sign up for RealNex today.
All right, let me change the presenter to Glenn. While I'm doing that, Glenn, you'll have the screen, be able to pull up your deck and take us on a tour of the real estate industry in about 45 minutes. We'll follow up with a Q&A at the back end. Use the chat feature, the question box on your screen to pose any questions, and we can come back to that as Glenn wraps up his presentation. Again, we'll go about 45 minutes and find out where we're at, what are the key drivers and the cycle stage of the top 54 markets across the country, and see where we're at, where we're headed, and what the opportunities look like. So Glenn, I will turn it to you.
Okay, great. Can you see my slides now?
You've got it. Yep.
Okay, and I just went to full screen. That's still good?
Perfect.
Okay, great. Welcome, everybody. Happy to talk with you today and tell you where my research says everything's going. I finished my first quarter research about a week and a half ago before everything started to unravel with the coronavirus, and we'll kind of pick up and talk about that mostly on the end, but I'll throw in a few comments as I go along. Three major drivers for all types of income producing real estate are population growth, which today is running about 0.9% in the US. And with 330 million people, that equates to 3 million people a year, meaning that we need to build a complete city the size of Denver, Colorado every year to meet those space needs for all those people. GDP growth, I think, as you all know, has rebounded from the Great Recession in 2009. It has been averaging around 2% for the last 10 years. And the forecast from the Congressional Budget Office is that it should continue to do that. It's just sub 2% for the next 10 years. Assuming that the coronavirus is a temporary blip like SARS and the other pandemics that we've seen in the past, it could be 3 months, 6 months, 9 months, or a 1 year slowdown that would slow that down a little bit. Employment growth also has been running since 2011 at kind of the 2% range. It has begun to slow a little bit, and that's mathematically because of the fact that the federal government expects more baby boomers like me to be retiring than millennials coming into the workforce. Also, with a very high or very low unemployment rate, bringing additional people in is obviously more challenging than it has been in the past. So it kind of goes down to within 0.5% in the next 2 years, down to kind of 1/10 to 1/20% through 2005 before it starts to pick back up. That it probably will be higher only because many of the baby boomers like me don't end up retiring, or we do from our major job, but pick up other things to do afterwards. Inflation, again, has been running in the 2% range, although somewhat volatile since the Great Recession, and the forecast from Congressional Budget Office said it should be in the 2 to 2.5% range for the next decade or so. Moderate inflation is, I think, good for real estate. It means the cost to operate properties doesn't really go up a great deal. And then 10-year treasuries, again, since the Great Recession, running in the 2% range. This graph is already old in the fact that we actually had 10-year treasuries drop to 1% here in the last 7 days, which is a new unprecedented low over the last 65 years or so. And every single year, the forecast looks the same. It's going to go up. And then, of course, it doesn't really get there much. I think we're going to see 10-year treasuries hanging with a beginning number in the 1 to 2 range for at least the next 3 or 4 years. So the cost to finance is low. As I think you all know, employment growth drives demand for space. So here's employment growth in all the occupied space types. And you can see that they do move fairly closely together. Industrial is one property type that's going faster than employment growth, mainly because of the Amazon effect and the fact that we have so many more items to choose from instead of just Coke and Pepsi. If you're a Coke person, you got Coke, Diet Coke, Cherry Coke, Vanilla Coke, Lemon Coke, Lime Coke, all these other options that have to be stored. And grocery stores have grown in size from 30,000 square feet to 120,000 square feet to have the shelf space to give us all of those options. Here is kind of the history of some cycles, and you can see that we've got long expansionary cycles when both GDP and employment growth are positive, and then recessions when employment and GDP drop. Recessions are typically very short, within 1 to maximum 2 years. Growth cycles have been in the 5 to 10 year range in the past. And the key here that I want to point out to you is the fact that while we have made it to 10 years in this current expansionary cycle, hence many economists' statistical models automatically say it's got to be a recession next, that potentially doesn't happen. And you can see here that This time around, both GDP and employment growth are at a much lower rate than they've been in the past. So there is a good chance that we can maintain a lower for longer expansionary period, possibly as long as what Australia has done. They're currently in their 29th year of economic expansion without a recession. So to me, real estate is broken into two parts: the physical cycle and the financial cycle. And the key metrics that we care about as far as presenting total return to investors are occupancies, rents, and property prices. So let's start by looking at the physical market cycle, which is demand and supply for space. That drives occupancy levels, which is the inverse of vacancy. Occupancy drives rent growth. And if I add a change in occupancy to a change in rent, I've got the income growth for any property. And that's what we're going to focus on first. So back in 1992, I developed a simple chart. It's basically just a vacancy or an occupancy cycle with four phases: a recovery and expansion, a hypersupply, and a recession phase. So it's vacancy turned upside down. We get declining vacancy on the way up and increasing vacancy on the way down. Typically no new construction in the recovery phase, a lot of new construction in the expansion and hypersupply phases, and not new starts, but typically completions of projects that have begun in the recessionary phase. So what should really happen is rent growth is typically tied to this. And you can see at the bottom, points 1, 2, and 3, negative rent growth. From there, we get rent growth, but typically at a rate below inflation. At 0.6 and 0.14, which are the long-term occupancy average, which I calculate for each city, and they're different for each city. So as an example, occupancy, long-term occupancy average in New York City office has been 91%, and it's only been 87% in Denver because it's a smaller, faster growing city where it's easy to put up new properties. Above that, at points 7 and 8, rents start rising rapidly towards new construction levels. And 0.8, you see I've got in green, which is cost feasible new construction rents, i.e. if it costs $400 a square foot to build a new office building in Denver, and investors are looking for a 10% rate of return, we have to have 10% of 40 or of 400 or $40 a square foot to cost justify building that new building. Above that, demand is growing, supply is trying to catch up, so rents typically grow at a pretty high rate. We finally get to the peak, and the peak occupancy is also a point at which demand and supply end up matching up and growing at the same rate, or your old Econ 101 class calls that equilibrium. After that, one of two things will happen. Either we get really high supply growth, higher than demand, or we have a recession and demand drops off and thus supply is still growing faster than demand, hence hypersupply, more than is demanded. That continues through the rest of the down cycle, and as we cross through the long-term average, probably get rents below inflation. So the study that I published now a long time ago shows that rental growth is negative at the bottom, points 1 and 2, starts to turn positive at 0.6. Rental growth averaged 4%, and during that same time frame, inflation back in the 70s and 80s and 90s was running at a rate of about 4%. Then you see very strong rental growth, with the highest growth rate in rent being at 0.10 on the cycle at 12.5. And then rent continues to grow, but at a decelerating rate, 11, 10, 6.1, and then 3.3 as we get to the long-term average, again, there on the cycle graph. And then finally, low and negative as we go into that recessionary phase of the cycle. Oops. Same Same study for industrial, same results. Again, highest rent growth at point 10 of the cycle. So let's look at where we are today. You can see that pretty much all of the property types are in the growth phase of the cycle, except for apartments, which has a minor amount of oversupply. 2 weeks ago, when I'd asked the question, the majority of the audience would say that we're probably at point 9 or 10 on the cycle. With the coronavirus, we could be at point 11 in the economic cycle, heading into point 12. We'll see how quickly it recovers and things balance out. If we go and look at the office markets, you can see the national average there at 0.8, and markets spread across the country. One of the key things that you all want to do is know the economic base industries that drive growth in your city. And by that, I mean an economic base industry provides a good or service that it exports outside of the local economy to bring money in to help the market grow. So Detroit, Michigan, obviously has been driven by the auto industry for years. Now they've got a tech company with Quicken coming in, so they've got a second economic base industry to help them grow. I'll make a very clear point of this by comparing two markets in Texas, excuse me. You'll notice that Austin, Texas is at 0.12 and Houston is at 0.14, both in the hypersupply phase. They're both there though for opposite reasons. Houston is in the hypersupply phase because its economic base industry, the oil industry, has been in a moderate decline for the past couple of years due to low oil prices, a surplus of oil in the marketplace. So the amount of marketing and research and exploration that they have to do has dropped off, and the oil industry has been laying off people. So it's actually a situation of declining demand in Houston. Austin, on the other hand, is now one of the hot technology markets in the country. Tech employment has grown rapidly there. It's a place where young people want to live, and in many cases, companies are going to where they can attract the talent the easiest. And so many people consider Austin to be the next Silicon Valley. The problem is that Silicon Valley in San Jose, California, is an extremely high cost of living part of the country, and hence harder to attract people. Austin still has reasonable housing prices, is a quote unquote cool place to live with a great music scene, etc., and has been ranked, excuse me, in the top 3 cities for the past 4 or 5 years as far as attractiveness for millennials to live in. So with all that new demand, the local office developers have been out putting up just a little bit too much space, so that their occupancy level has kind of dropped off from a peak. You'll also see here on the slide that I happen to have Boston highlighted in yellow. It's because this presentation I just gave at Harvard last Monday at my annual class presentation to Harvard real estate graduate students. And the +1 behind Boston means that it has moved up from 0.8 from the previous quarter. So in the third quarter, Boston was at 0.8. Now here we are in the fourth quarter, and it has occupancies have improved, and it's moved up to 0.9. You'll also note that there happen to be 11 markets on here that are in bold and italics. Those 11 markets are what we call the first tier or macro markets in the United States. They make up 50% of all the square footage that exists in all 54 of these markets that are on the graph here. Okay, industrial. The Amazon effect continues. Demand for industrial has been phenomenal, and it continues to grow and probably will continue to grow. If anything, while there may be a little bit of a slowdown in goods moving through the system right now with China having shut down many factories. The less people contact that everyone is considering would drive even more demand into industrial warehouse space. Here you can see again, Boston is at peak as well as many other cities. The ones that are in the hypersupply phase are where they put up just a little bit too much speculative warehouse space. Okay. We look at apartments, Boston at a peak, but pretty close to half of the markets in the hypersupply phase. Apartments being the least risky of the major property types, and the easiest to finance means they're also pretty easy to build. They also lease up quickly because if they have a problem with leasing, all they have to do is drop their rents to match up with older buildings. And why would a person not want to move to a brand new building for the same rent? Retail, again, almost every market in the country at a peak, including Boston. And this seems a little counterintuitive. I'm going to hold on that explanation until I get into the forecast. Let's just take a quick walk back in history and look at demand and supply for office space. You can see the first half of the 70s with demand at around 2 and supply at around 5%. Hence, occupancy is going down for that first half. And then the second half, baby boom generation started to go to work, especially in office space. And you see more demand than supply, hence increasing occupancies. We moved to the 1980s, and here, every single year, we saw way more supply than demand. Supply actually grew at an average annual rate of 7.7%. And if you did the compounding on that for 10 years, we more than doubled the amount of office space in the United States in that one decade, which is pretty incredible. On the other hand, demand grew at a rate of 3.8%, which is actually the most incredible thing on this graph because population was growing at 1%. Employment was growing higher at 1.4 because of the baby boom generation actually coming into the workforce. So the fact that demand for office grew at 3.8% is pretty amazing. The reason for that was that the US economy was going through an economic base employment shift. In the 60s, 25% of all employment was in manufacturing. Today it's 8%. Back in the 60s, 8% of all employment was in office using jobs. Today it's 30%. So we shifted from being a manufacturing country to being an information technology but basically office employment type using jobs being a dominant factor for the country. Okay. 1990s comes along. Oh, and by the way, so if you will, more supply than demand, we actually went through a down cycle for the full decade, all 10 years. 1990s, we went through an upcycle for the entire 10 years because there was more demand than supply. But note that this is a pretty low rate, averaging just in the 2 to 2.5% range versus the previous decade, which was 2 to 3%. And here you can see the left-hand side of the chart was 0 to 10%, whereas the next decade it's only 0 to 3%. Beginning of the new millennium, supply outpacing demand in 2000, first time ever. Demand going negative in 2001 when the technology bubble burst, picking right back up to over 2% by 2005. Slowing down and going negative again in 2009 with the Great Recession and turning right back around. So employment growth is a major factor of any economic cycle, and you can see that happening. You can see supply growth lagging by a few years. In other words, as demand growth turned down, it took supply growth 2 years before it started to slow down. And then when demand growth picked up, it took supply growth a few years to pick up. So that lead and lag causes more variance in the cycle. Finally, current decade, you can see that every year through 2018, we had more demand than supply. So office occupancies rose across the country. And in 2019, that started to turn the corner and is expected to do the same thing this year as we go forward. So if we look at all the property types, if you remember when I started, pretty much 2% GDP, 2% employment, 2% interest rates, 2% inflation. The demand side of real estate is, projected to grow at moderate 2 or sub 2%. Here, if we look at all the different property types, they have all been growing at a low 2%, except for one property type, and that is apartments. With that easy financing available for developers. So let's just kind of click through and look at the history. Here's the occupancy cycle. Peak back in the early 80s, bottom in 86 and kind of 91, a peak in 99, a bottom in 2003, a peak in 2006 and 7, a bottom in 2010, just as the recession ends. And then kind of peaking here in 2019, 2020, but kind of hanging in that equilibrium level for a few years at a somewhat slow rate. We'll see where that goes. And then you can see the rents growing overall at 52% cumulative. So that's taking plus years and minus years and adding them together. And the occupancy rental correlation between those two being almost 79%. So we know that if we've got occupancies growing, rents are most likely going to grow with it. So when I look at the forecast, if you recall, Boston was at 0.9. Here it shows to be at 0.10. Houston gets a little better because we thought the oil industry would be recovering some and increasing demand. And in Austin, things are getting a little worse because of that overbuilding. When we look at the industrial sector, again, a high equilibrium, a high occupancy level that looks like it's going to last for a while. The rent growth has been really strong at 6%, which I think will start to slow down a little bit here over the next few years, but it's still 3 or 4 years until we get to just the rate of inflation. So right now above inflation in industrial rent growth. And again, kind of half the markets at the peak and a number of markets moving over the top as the economy slows a little bit and we continue to potentially overbuild industrial. And then apartments, same kind of cycle with, again, a peak back in 2015, another one in 2019, but we expect to see things slow as we go. So apartment, again, same markets at peak with a few over the top. And then finally, retail. The most surprising thing, of course, is the fact that retail occupancies today are higher than they have been in any of the previous cycles. We've got a 94.5% occupancy rate in retail today. That looks like it's going to slow down a little bit. And that, again, people, that doesn't make sense. I keep seeing stores go out of business. True, but if a store goes out of business and the building is repurposed as office or industrial close-in last-mile warehouse space, or even some have been converted to apartments, then that stock is taken out of the market. And if retail growth is only 1%, but stock is 0.5%, occupancies continue to improve. And again, we see the majority of markets at the peak in the cycle. So with expected moderate economic growth, I expect to see continued occupancy and rent increases, increasing the income side of real estate. On the financial side, I believe it's capital flows that really drive real estate prices. And what logically should happen is the blue line here is the property cycle, and the capital flow cycle in black. When rents aren't going up not very many people are buying, hence it's a flat line. As occupancies and rents start to increase, capital starts flowing in. It gets to its steepest level in its curve as it goes through cost feasible rents. It peaks out in the hypersupply phase and drops off very quickly. Reason for that is the two types of capital flow. Capital flows to existing properties. If you buy a property for more from me for more than I paid, more capital just flowed in and prices are going up. And then capital flow to new construction, starting there at the cost feasible dot. And if you started it, you're going to finish it even if it's down in the recession phase. So real estate is a separate asset class. We've got stocks, bonds, commodities, real estate. And real estate compared to stocks and bonds is a little smaller, but it still makes up over 20% of the investable universe. And institutional investors, wealthy individuals, family offices, all have allocations to real estate today because it doesn't act like the stock or bond market. And if we look at the history of interest rates on the bond market side, interest rates are at a historic 60+ year low. The average yield on 10-year treasuries, which is what we use as the benchmark for the long-term, risk-free rate in the United States. Here, you can see that that average has been just under 6%. And of course, as interest rates go down, bond values go up. So the total return over the past 30+ years has been about 8.3%. But we can't repeat that in the next 30 years. It's going to look more like when I was born, and between 1953 and 1973, when interest rates went from 2 to that long-term average of almost 6, the total return was only 1.9, because as interest rates go up, bond values decline. And the average total return between 53 and 1981, when 10-year treasuries peaked at 15%, was only 3.9%. So people are looking for yield, and they're not finding much of it in the bond market. Another good reason for real estate is that it has less years of negative return than either the stock or the bond market. And if we look at capital flowing to real estate, Real Capital Analytics, if you don't receive their information, you should definitely consider getting it. They track every income producing real estate transaction in the US over $2.5 million. And I use that term instead of commercial because apartments are included in here. So starting in the first quarter of 01, 20 billion of transactions, going to 160 billion in 07, to 15 billion in 09, back to 160 billion in 2016, and it's hit that $160 billion a quarter level now a number of times. And Real Capital Analytics produces their, it's called the Moody's Real CPPI, Commercial Property Price Index. And that's overlaid here in green. And you can see that the price index correlates very closely to capital flows. Let's break that down into property type. From that 2007 peak pricing, after the correction, it took a number of years for prices to recover. And today, on average, real estate prices are 34% higher than they were in 07. Apartments are 83% higher. Retail hasn't quite fully recovered. It's only at 99% of previous peak. Industrial is 134% or 34% higher than the previous peak. CBD office 139 and suburban office 104. So picking property types and how they move based on the demand that's there and the supply is something that's important. If we look at cap rates over time, the cash on cash return back in 2000, they were running in the 8 to 9% range. By 2006, they were down into the 6.5 to 7 range. And then with the Great Recession, they bounced back up into the 8.5 range. And ever since the technology bubble burst, everybody wants that hard asset that won't vanish into cyberspace. And we've seen cap rates work their way down. So this graph makes real estate look expensive. But we need to constantly remind people that we are in a lower yielding environment than we've been in the past. And what we need to do is look at real estate relative to the other investment options we have. So the stock market today has a dividend yield of 1.2%. The bond market, 10-year treasuries, the risk-free rate are down to 1.1%. And so let's look at the yield, the cap rate yield on real estate, and how much above the 10-year treasury you're getting for taking and making that riskier investment. Back in 2001, you were getting about 4%. In 2007, you're only getting about 150 to 200 basis points more. Today, you're getting anywhere from 350 to 500 basis points, and or at hotel at 650. So you're getting a very attractive additional yield for taking the risk of investing in real estate. You know, in my career of 40 plus years now, when I started, it was a local buyer, local seller, and a local bank doing the financing. In the 1980s, along came the institutions, the pension funds and endowments. All of a sudden, we had national buyers, national sellers, and national financing. Then in the 1990s, real estate got its first real access to the public capital markets with REITs, real estate investment trust for equity, and commercial mortgage-backed securities, CMBS, for debt. Finally, in 2000, we started to see real estate investing really expanding around the world. And Real Capital Analytics now tracks capital investment across the globe. And here you can see the dark blue line are U.S. money going into other countries. For instance, U.S. put 11.8 billion into Germany in 2019. Into the United Kingdom, 8.5 million, Spain, 6.7 million, and then the percentage change from the previous year. It was up for Germany. It was pretty flat for the UK, mainly because of the fears on Brexit and what might happen. And with Spain, it was down substantially, and not sure that I have a story to tell there. But money is flowing back and forth between all kinds of countries. And so the key to think about here is the most expensive property you could buy in the United States today would be a downtown New York City office building. It would trade at a 3.8 cap. That same location and quality building in London would trade for a 2 cap. And that same location and quality would trade in Hong Kong or Singapore for a 1 cap. So foreign investors from London look at these and go, wow, these prices are almost half of what they are here in London to get the same yield. In Singapore, with a 1 cap rate, the US building looks like a 75% off deal. So we're seeing more and more capital flow in. It used to just go to those major cities that I have bold and highlighted. So in other words, sort of the gateway cities of the United States, the big ones that people feel very comfortable in. That has started to trickle down or spread out to second tier markets like Denver, Colorado, where we're seeing some foreign investors coming in and buying. And then we've also got a 4th tier of cities where we're moving things down the road. So all of a sudden, the international buyers are moving into second tier cities like Denver. The institutional buyers who used to do 1st tier and 2nd tier cities are now going into 3rd tier cities, and the wealthy investors and family offices that used to do 2nd and 3rd tier cities for the higher yield are also moving into the 4th tier cities. So one piece of good news is that the debt service coverage ratio this time hasn't fallen off. It's actually held and is higher than it was in the past cycle. Part of that being because banks are requiring a larger down payment. The new risk-based capital rules they have really don't allow them to lend much more than 60% loan to value on commercial buildings these days. So we're seeing a much higher debt service coverage ratio, meaning that the investment for both the mortgage banker or mortgage holder and the equity holder are much more stable, even though cap rates have gone down and prices have gone up. Off of NAREIT's website, you can pick up this chart that shows the cycle lengths from previous cycles by NAREIT, and notice that they've got 17-year plus durations. The first one, 72 to 89, had an average 13.9% per year return on the REITs. The second cycle had a 14.3% per year return, and the third one dropped off. All right, the third one we're not through yet, but due to that decline of the Great Recession, it took 6 years to gain all that back before moving forward. And today we're only 3.9% above the in return per year. So my conclusions: economic cycles can be both short and long. We're currently in the longest economic cycle since World War II. Corona may or may not stop it. Certainly will probably slow it. Long-term expansion means a long-term upcycle in real estate. And the cycles are driven by demand and supply. You need to be watching both those things. We've been in a very low supply growth rate since 2013. And all but apartments have been below 2%, helping to have the markets improve. And how long will that last? 4 weeks ago, I would have said another 10 years. Today, I don't know. We're definitely going to have a slowdown. Whether we go into a recession is the real question. So 2020 financial cycle, capital flows affect prices, and we've got a volatile stock market and very, very low bond rates with high prices. Real estate has been the more stable and safe investment over the last decade, which has been attracting more capital. Debt financing is harder in this cycle, requiring more cash equity down, hence less speculation. I think that helps keep the markets in balance, and very low. So in everything you do, one of the things you want to do is make sure you differentiate between residential home ownership and commercial real estate. Residential home ownership is a production process just like cars. You buy raw land and materials, build the building. You don't make any money until you sell it. When you do, all that's left is you to take care of a warranty. So it's unique in that housing does one thing. People ask me all the time if I can do my cycle work on this, and the answer is no, because my cycle work uses occupancies and rents, and houses have neither of those two factors. So they're different, and I think that we're in an interesting time with a new challenge and an unknown. And with that, I'll leave it up for questions, and if I can give you one quick thing, anybody interested, if your kids are looking for a place to go to school, we've got an undergraduate degree in real estate and or construction management. We've got a full-time graduate program, also an executive program that's online if you wanted to get your master's in science in real estate from us at DU. We also have certificate programs if you want us to put together 4 specialized courses for you with a certificate. And we recently started a PhD program in the business school, and you can actually major in real estate. And with that, I will turn it back to Jeff.
And you're not too far from the ski resorts.
Not a bad place to live, and not a bad place to be. Glenn, your mic was coming in and out a little bit, so I don't know if there's anything as we go through the Q&A I apologize to the audience. A number of people mentioned it, so I just want to let them know that it wasn't on their side. It was just
okay.
coming.
Sorry about that.
No worries.
I don't think I moved much in the last 45 minutes.
Yeah, I don't know what's going on, but in any event, it was all clear. Just a transition from time to time. Jeff, you did some work with Norm Mueller, not to be confused with Glenn, on this coronavirus. And let me turn it over to you for a second as we field some questions. You may have some
pull that up.
here.
Yeah, I just undid my screen sharing.
Let me get it over to Jeff. Here we go. And while we're doing that, just keep coming with the questions. And we'll come back to them in just a minute.
Is it showing my screen now?
Yep.
Okay. And let me just go to full screen here. Okay, this is just a one pager. And as Jeff said, Norm Mueller at the University of San Diego put this together and gave me permission to summarize what he had done. And so first of all, no one knows for sure what the impacts are going to be. With a lot of speculation on this now, but to kind of summarize some things that Norm was able to put together. And I've seen pretty much similar comments from other sources. We hear a lot about the supply chain disruptions that are going to happen because there's obviously going to be less imports from China. I know I ordered something about a month and a half ago that was coming from China and hasn't shown up yet. They keep saying, well, someday, but things are really slowed down. So that's going to impact manufacturing because a lot of the manufacturing in the U.S. depends on products that the raw materials that come from China, and also going to impact retail. A lot of clothing, electronics comes from China. Obviously, hotel occupancy is going to be impacted. Many conferences, as I'm sure most of you know, are being canceled or may be canceled. In fact, I was supposed to be in Phoenix this week at National Council of Real Estate Investment Fiduciaries Conference at the Biltmore, and about a day before that conference was to start, everybody received an email that registration was so low because the company's restricting travel to conferences that they had to cancel and move it to July in Phoenix. I guess it wasn't hard to get back in the Biltmore in July in Phoenix. Fitness centers, movie theaters, restaurants obviously will be impacted. Really any place where there's a lot of people, we're being advised to avoid. Maybe that'll be temporary, but certainly will have a short-term impact. There will be more use of video conferencing. I mean, that's been a trend for a long time, but I think now it may really push some companies over the edge to just say, hey, we're going to rely more on video conferencing using Zoom and GoToMeetings and other software, more telecommuting, so that could lead to even less space for employee and demand for office space. Shared office space in particular, the WeWorks, the whole idea of sharing office space, how close do you really want to be to other people right now in shared office space? Maybe more of a trend towards online grocery shopping. We've started to see some of that, Amazon and others getting into the business, but that could, again, be a tipping point where now we really want to do more online ordering and not have to go out to the grocery store. Bulk port warehouse that depends on imports is going to be hurt the most, although the so-called last mile warehouse used for e-commerce is probably going to benefit. And we've seen that's been really where the demand has been for warehouse space recently. Of course, we've had this drop in stock prices, although today there was a recovery of over 1,000 in the Dow, but tomorrow could be back down 1,000. So who knows? The drop in stock prices and how that's impacted retirement accounts could make potential investors feel less wealthy, which could ultimately impact their willingness to invest. Could be a mild recession, hopefully not much of one, but this could, and Glenn kind of touched on this. In fact, that was built in to some extent in his GDP forecast. Maybe the good news in all this is interest rates are likely to stay low, maybe a good time to refinance. And one of the reasons the market was up today is we may see some fiscal stimulus coming out of Washington with lower payroll taxes and potentially other stimulus. So that's sort of a summary of what's being said at this point. It's a black swan, which means we really don't know the impact. Glenn, anything to add to that?
No, Jeff, I think that's a relatively comprehensive review. Although one thing is, obviously, if we're going to have less people contact, that means more things are going to be delivered. So the potential long-term demand for industrial just increases even more if we're going to be taking, having more things delivered as opposed to picking them up at retail stores.
Yeah,
Jeff,
while
did
you're,
any questions come in?
yeah, questions are in, not all on coronavirus, luckily and thankfully. We've got something else to talk about. The single family rental REIT. Glenn, I don't know if you've done any work on that, and does that the formation start to come into your? You mentioned that single family was different in the past. It has been, but as more single family homes were built for rental or have been converted to rental in portfolio, are you seeing anything that you can comment on, and have you done any research in that area?
So single family rentals obviously started in the Great Recession with a lot of foreclosures being picked up and used for rental. Many of us thought that would be short term and that when home prices came back, those would be sold off at a profit. But they actually figured out how to property manage hundreds of separate buildings with hundreds of roofs and heating systems and everything else. So it has now become a viable, if you will, subclass of rental housing. So I'll use that term. So you've got apartments, and then now these single family homes. And it appears that many people in the millennial generation, as they get married, have kids, and want to move to the suburbs, either don't want to or can't afford to buy a home. And so the demand for those appears to be there. And that obviously is also one of the reasons that we see a slightly declining occupancy rate in the marketplace, because each one of those is just another, living rental unit in the marketplace. So that's also part, if you build a 200 unit apartment building and you build 200 single family homes for rent as well, they're competing with each other or they're adding to the supply of the marketplace, hence one of the reasons for the oversupply.
Excellent. Back to the corona or other just lifestyle change type of impact, we see the immediate reaction to the slowing supply chain and commodities. Do you see any longer term behavioral changes in consumer demand, lifestyle, as well as inside of buildings? What are the things that you would expect to change from monitoring and air quality control and even long-term regulatory issues that relate to travel and global business, and how that might be a long-term impact?
My understanding that, the coronavirus is actually water-based transmission and it's only to the lungs. And so standing in the same room, breathing with someone who has it, you're not going to catch it. But if they cough or sneeze or touch something that then you touch, it's now been transferred to your skin, and we touch our faces hundreds of times a day, and that's where the actual transmission happens. So clean technology, I think, will be another new business coming out of this. How do we control, surface to hand contact and make that happen? One of the things that's happened in retail is that as opposed to spaces to sell stuff, you've got a lot more spacious for social gatherings. Restaurants have grown tremendously, brew pubs, escape rooms, all kinds of things where people want to get out and do things because they can do. They might be working from home, but they don't just stay home after work then. They want to be out and be social. And so how we have social events going forward, I'm sure there will be new protocols that will allow for that, because it certainly is a major portion of our, of our economy and our society. It would be very interesting to see if, they continue to shut down any any large gatherings. That would completely kill off the sports world, pretty much.
I wouldn't be surprised if, 3-4 years from now, we've forgotten all about this though. It's always amazing how short our memories are when it comes to things like this. How many of us, I want to really remember SARS until we were reminded of it recently?
Right.
It seems like a lot of these types of events, they have short-term impacts and they impact property values and disrupt the way we do things, and then things go back to normal after a couple of years.
I guess what is normal though is the question. I know that it has been a trend for shared office environments, and I know when they first came out, that all the thought wasn't put into the contagions that could be in, and the cleanup that was required. And so when people started to move into that space, they were impacted by the need to have more frequent cleaning of space, not just the daily cleaning that could have been in an office, but more frequent in between visitors that came in. And just that there's sort of going to be I think a trend towards constant cleaning in any type of environment that has people coming and going, whether they're talking about the change in frequencies on planes to trains to what will be undoubtedly in restaurants and like movie theaters and the seats, everything that you have one person coming in after another and then another. And Glenn, as you talked about, you put your hand down where somebody else did, and it's just there's a risk that wasn't as well foreseen in the past that could be better foreseen and managed now. So it obviously takes some time and make some changes. But back to the next question, I think the final question on underwriting based on the DSCR requirements is shown to be strong, but they're in apartments, the ratio is looking like 75 to 80% loan to value. I don't know if you're seeing any changes in that standard.
Not really my area of expertise, so I'm not sure I can give you a good answer.
Okay.
I'll be consistent though with the higher debt service coverage ratios that you showed, that the LTVs would be a little bit lower than we've seen in the past.
Are you seeing any impact to construction costs as we go through the different cycles?
Construction costs are definitely up. The demand, construction labor is harder to find. Materials costs have been going up way more than just the regular consumer price index. Now the shortages in China, the first one to come along. One of my good friends works at the Steel Institute, and we're going to see increase in steel prices, delays in some cases, that kind of thing as well. So, and if anything, that probably slows new construction, which helps keep markets either in balance or in the growth phase of the cycle.
We'll take one final question and then wrap up. Thank you. Any observations on Bitcoin or cyber currency from either of you in any of your research? I know it's a little bit of a different topic, but the distributed ledger technology and how that might impact real estate transactions.
Bitcoin has been resurging a little bit here recently.
Of coronavirus for a while, and then it's just kind of died away. And I don't see hardly anything in the news. And I read all the real estate news. I see very little about it.
Well, we are on the top of the hour again. Great cycle review, Glenn. Thanks for the recap on coronavirus. Jeff, we really appreciate you coming back with us, Glenn, and sharing your observations and the research. It's interesting to watch how the markets are moving through that continuum, and hopefully all of our audience had somewhere close to home they were able to point to and see where they're at in the cycle and other markets that they're investing in and helping them in their decision and evaluation process. So thank you all once again for joining us. Everyone be healthy and be well, and we look forward to seeing you next time. Thanks, Glenn. Thanks, Jeff. Thanks, everybody.
Thank you.
Thank you.